Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. And today's blog was titled Two for Tuesday. And the idea here was to look for companies that are available now thanks to the recession that are on sale, therefore giving us good dividend yield at the same time some decent growth characteristics. And I've got two examples to share with you. My first one's Johnson & Johnson. I want you to know that Johnson & Johnson has been a great, investor or a great company over a long period of time. For the last 20 years, they've compounded earnings at 12.5%, and they've commanded a normal price earnings ratio between 20 and 22 times earnings, as connotated by the green line with the white triangles and the blue line with the asterisk. And as you can see, Johnson & Johnson has historically traded in line with this earnings growth. However, it did get very undervalued thanks to the recession, and it's currently yielding 2.9% if you bought it, through at August 3rd's price of $61.10. But what's really attractive here, if you look at the long-term result of Johnson & Johnson, you can see here that they've increased their dividend virtually every year. Went from 19 cents a share to 22 cents a share and so on. And if you kind of come up to where it's currently at, if you look at the 25 cents it paid in 1993, and today, you can buy it, as I pointed out, at a 2.9% rate of return. So stay very consistent here. You can see what would have happened to your yield and how long it would have taken. Within 5 or 6 years, your yield would have doubled, and then it would have gone up to double digits by, the next 8 or 10 years or so. So the point is, when you look at this particular performance record, $100,000 invested in 12/31/1990 would have grown to $681,000. That's your first one, 10.9% compound rate of return. But your two-fer, that is your dividend yield, which has increased year after year after year over this 20-year period, which would have thrown out over $188,000 in dividends. And the average yield there is obviously very attractive, as you can see, and would have, probably done better over the last 20 years than any bond you could have bought. So Johnson & Johnson is a clear two-fer. It's one that gives you good growth potential from here, as well as, good long-term income benefit. My second example is Procter & Gamble, another really fine, extremely high-quality company. As you can see, the Procter & Gamble has had similar growth to Johnson & Johnson, a little lower, 10.6%. It, however, is also traded at around 20 times earnings, as is connotated by the blue line. You can see at the current price-earnings ratio of 13, the stock is clearly on sale. And even though we're having a little hiccup in earnings right now, earnings are still very strong. This company reports earnings, by the way, tomorrow, and I thought it would be fun to talk about it today because we can look tomorrow and see how it does on an earnings basis. But buying it today at 2.9% yield, if you look at it historically, the track record of this company relative to the S&P has been very strong. It's averaged over 9% a year compounded. But just like Johnson & Johnson, they've increased their dividend yield every year. And by the way, the average here has been about 11% in terms of 11.2% in terms of dividend growth over this period of time here. So here's a second example. $100,000 in Procter & Gamble would have thrown off $140,000 in dividends. Has about the same yield as Johnson & Johnson. By either one of these really fine companies today, you can clearly see that if you look at it historically, over this last 20 years, 2 decades, the stock has neither one of these companies ever traded at such a discount. We think this is a great time to be making long-term investments in these super companies. We'll have to watch Procter & Gamble tomorrow to see what happens. This is Chuck Carnevale saying thanks for listening and look forward to talking to you again.